as you await these results, we always ask analysts like you, what are the things that you want to watch most closely for? So what are you going to be watching most closely for?
I think there's three things. The first is the market is a little bit nervous about a macroeconomic slowdown. And so we can't see any hints of that in the experiences, or formerly known as theme park segment. Second thing we need to see is reiteration of the double-digit adjusted earnings guide for fiscal 26 and 27. And the third, and maybe the messiest, is we don't want to see a lot of noise in the direct-to-consumer segment. And there's a lot of reason for noise. You had the Jimmy Kimmel dispute. You've got Hulu rolling out globally. You've had price hikes. And you have ESPN Unlimited launching. So a lot of cross currents there, but those are the big three.
How much, Jason, can you maybe filter out or kind of cull out some of those extraneous problems, some of the messiness that you're talking about in terms of the fundamental story? Those things do have an impact, but they could be fleeting in nature. So how do you keep an eye on that kind of medium to longer term story as opposed to the near term noise?
Yeah, we try and ignore the noise. I mean, the big thing the street wants to see on the DTC side is top line reacceleration. And the consensus has that modeled in primarily on the expansion of Hulu globally. And the company has talked about, double-digit operating income is sort of their guidance. So we need to see a reiteration of that. I think the biggest opportunity for this company longer term, and it may occur under the CEO after Mr. Iger, is sort of a doubling down of the investment in the DTC app to really position Disney as a pay TV substitute. Right now it's not. Netflix is really the only firm that holds that position.
In your mind, what exactly are the one or maybe two things that are the biggest driver of investor sentiment when it comes to buying and holding on to Disney shares?
Well, so Disney historically has traded at a premium to the S&P 500, and now it's trading at a discount. And I think the primary reason is top line growth. This company just isn't perceived to have the same sort of oomph in terms of the top line. If they get it, it requires capital investment in the parks, content investment. But I think the market has generally been supportive of bigger investments to fuel top line growth, particularly American investors. Europeans can be a little bit different, but at least American investors, they'll always pay for top line.